Hello, my name is Jacob Kerr, and I'm with Stephen Archer, and today we'll be talking about chapters 5 and 6 in his book, The Mind and the Stock Market. Stephen, how are you doing today?
I'm doing just fine.
That's good. Any news the past week? Anything new with you, or?
No,
No?
the market seems to be just waiting for something.
For something. What's that something?
That probably now is the government shutdown.
Oh,
I'm sure the market would like to see that resolved.
resolved?
Yes,
And when do you think it will end?
that's entirely up to the politicians.
Fair enough. So,
I didn't cover that in this book.
I know. Just weekly, daily current events.
Right.
So I read the chapters. I'm curious. So how does one buy a stock?
Well, I might start out by saying very carefully, one really is buying a partnership in a company of their choice. So when they buy a stock, they're really becoming a partner in that company. To begin with, then, they should find out if the business that they are in is one that you like and you can become familiar with, or you already are familiar with. And then you should study how they, as a company, are performing within that particular industry. Whether they're growing, whether they're earning money, whether they have management that is regarded highly, and are they paying dividends, or whether they're reinvesting all the money, and so on. So to go and buy a stock, you need to know, as I'm saying, what stock you want to buy. If you really want to go through the mechanics of it, what you need to do is find an agent who can act for you, because the purchase and sale of securities are limited to agents. For example, the New York Stock Exchange only has so many hundred members of the exchange to execute transactions, and therefore you need to find somebody who has a membership on that exchange. So to do that, you need to find an agent, which usually means find a broker who will contact the right person and purchase that stock for you in exchange for a fee called the Stock Exchange Commission. And that's what the member of the stock exchange earns as a result of buying that stock for you. The purchase then of stocks is usually such that you must surrender your funds in payment for that, and in exchange for that, the shares are really not delivered to you normally. The brokerage company normally keeps a record of the purchase that you have made. Therefore, it's very easy for you at any time to have those available for sale if you wish to do that.
So there's no other way besides a registered agent to buy stock? That's the only way? Or are there other ways besides that?
There are other ways,
Okay.
but it's very difficult and unusual. If you happen to own shares that I want, you could sell them to me. But finding someone who owns those shares is difficult.
Okay,
Yeah.
that makes sense. So how do you determine when you want to sell your stock? What factors or indicators play into?
Well, you certainly want to know if they're earning money and whether they've had a pattern of continuing to increase their earnings, which is usually a very desirable factor in selection of that stock. And if you're interested in immediate or continuing income, whether they are paying dividends or not. You need this because this is going to tell you all the profitability you can look forward to. And all of the earnings of the company and the dividends are shared among each and every owner or each and every shareholder. So you have to study the earnings and the dividends to determine whether they are going to be a growing company, a profitable company, and that's really the important key of that. Now there are some other factors that will influence the value of that stock or the price you have to pay. Sometimes the market as a whole is very ebullient or happy or enthusiastic, and the market as a whole rises. When the market as a whole rises, they usually carry everything with it, and that's a market factor that may increase the value of the share. So if you can predict the market, you may be able to be more successful when you purchase this particular share because it will rise with the market itself. Or industries have factors that influence the value of the various companies that are in that particular industry. If you're looking at a silver share, then you want to study and understand the silver business and what makes the silver industry a successful industry. If silver is not in demand anymore for radios or electronics, such things as that, all of a sudden, because of new invention, then that's a very sad story for silver producers. So it's the economy, the market as a whole, the industry that you're in, then the company itself. All these factors contributing to the outlook and earnings expectations you have for the company.
What industries do you see as becoming more profitable, or staying profitable over the next 10 to 20 years? What industries?
Well, I think the technology group is one that certainly holds a great deal of promise and is likely to deliver new and exciting products, and therefore obtaining a market for their particular products. And certainly healthcare, particularly companies that are interested in developing new products in the health industry. Those two are exciting companies and have expectations of considerable growth as they find out new products that are useful for the community. These are two immediate heirs. There are companies which are in the industry which are more stable. Namely, if you're looking for a company which has a steady situation where their sales are not booming or anything like that, but are steady and very reliable, you're just looking for reliable income, then you might want to look at utilities. Most utilities are regulated by the states for the amount of fares that they can charge the users of electricity, for example. So those things depend upon what you're really looking for. So
It's pretty good analysis. I can definitely see technology and healthcare being more profitable over the next few years. I was reading the chapters as well, and I came across the concept of earnings per share. So is it just that simple, or is there a more complex context behind earnings per share?
Well, the agencies such as the stock exchange and the government agency, which is the Securities and Exchange Commission, which keeps an eye on the finance industry, decided some time back very properly that the company should use a common measuring standard in terms of how they measure income or earnings. So the reports of companies which are computing earnings and earnings per share use the same accounting standard called GAAP D. General
Accepted accounting principles?
accounting
Sounds
principles. And those are really determined largely by a outfit or organization called the Financial Analyst Standards Board, which is located in Connecticut, and certain members of this board review certain problems that may occur in the accounting industry. And this has a heavy effect on the general GAAP, which is used by all companies then that want to submit their stock for public trading, and they must follow the GAAP, General Accepted Accounting Principles. So that makes it fairly easy to compare earnings of one company with another company because they're all using the same accounting procedure. Not that in some industries it's very difficult. Some industries they take as income before they actually receive the funds. Like oil industry, for example, where they count on expected delivery of oil, which is already above ground but not exactly sold to anybody else. It's important that the public understand that the accounting for earnings statement and accounting for the balance sheet of a company is done with the same principles as every other company. Otherwise, you couldn't easily compare earnings of one company to another company. So, earnings per share, or EPS it's called, is nothing but the total earnings of the company divided by the number of shares to get earnings per share. And this then is the price divided by the earnings per share is the price earnings ratio. Price earnings ratio generally tells you how expensive the particular stock is. And sometimes very good or good growth companies have a high earnings per share because the expectation for future earnings is very high. And that's true with the technology field. It's also true with the many healthcare industry companies. So earnings are very important. There's a public standard of accounting for earnings. The earnings and price ratios tell you how expensive the particular shares are, and if they're very expensive, that make you decide you don't want to pay that much for that particular company. And that's why it's important you do your homework and try to understand as well as you can the nature of the prospective growth of the company.
So it definitely seems that early investors want to invest in stocks with a high EPS. Is that correct?
Well, high EPS, earnings per share, is fine, except that low earnings per share can be too.
Okay.
Yeah, I mean, the price earnings ratio, the price you pay for earnings.
Okay, I think that's, I've heard
key.
that, yeah, okay.
Yeah, is the key in understanding what you're paying for a particular stock. So.
Okay. I think I might have got those two mixed up, because I definitely heard there was a ratio where you want to buy at a certain.
Yeah.
But that makes sense now.
So Amazon, for example, has a huge price earnings ratio.
Yeah.
And in fact, for many of its early years, it had no earnings at all. The huge price ratio, you couldn't really say that it's a price earnings ratio.
Yeah.
But the huge price was all based on expected earnings.
Yes.
So, and Netflix, for example, has pretty good earnings. It also has a very high price. That's a very expensive stock because Netflix has growth.
Yeah.
And people are expecting rising earnings.
Yes.
So sometimes you want to compare current price with earnings, what I think is going to be 2 or 3 years from now.
Definitely.
Yeah.
Well, thank you. That was very good insight. Definitely learned a little bit about investing strategy. Definitely when we want to invest and when we want to sell. So I want to thank you for the interview today. And well, thank you for watching, and we'll see you next time in the book, The Mind in the Stock Market. Thank you.